single day. I'm gonna make something great. That's my way.
Hello everyone, and welcome back to my channel. I am Ginger Wolf, and this is Stripped Finance. I am a feature entertainer and stripper, not a financial consultant. So any and all information received from this channel is meant only for educational, informational, and entertainment purposes. So please, if you have any questions or concerns, take it up with your financial consultant. Now with that out of the way, let's enjoy today's video. Bye! Hello everyone, welcome back to Stripped Finance. So today we're doing another Halloween double feature thingy. This is Harold, and I'm wearing my warm Halloween shirt because it's actually kind of cold in my house right now. And I don't know why. So I have someone coming to look at the heater tomorrow because it's a little bit chilly. So today we're going to do phantom stocks and the Halloween strategy. The article is by Mark P. Kusin on Investopedia. And it's Introduction to Phantom Stocks and SARs. Although rewarding employees with company stock can provide numerous benefits for both employees and employers, there are times when either legal concerns or an unwillingness to issue additional shares or shift partial control of the company to an employee can cause companies to use an alternative form of compensation that does not require the insurance of actual stock shares. Phantom stock plans and stock appreciation rights, or SARs for short, are two types of stock plans that don't really use stocks at all, but still reward employees with compensation that is tied to the company's stock performance. The key takeaways. Rewarding employees with company stocks has been shown to provide numerous benefits to employees and the employer. Phantom stock plans and stock appreciation rights are two types of stock plans that don't actually use stocks at all, but still reward employees with the compensation that is tied to the company's performance. A phantom stock plan pays a cash award to an employee that equals a set number or fraction of company shares times and the current share price. There are two main types of phantom stock plans: appreciation only and full value. SARs gives participants the right to appreciate in the price of their company stock, but not the stock itself. Phantom stock, also known as a shadow stock, this type of stock plan pays a cash award to an employee that equals a set number or fraction of company shares times the current share price. The amount of the award is usually tracked in the form of hypothetical units known as phantom shares that mimic the price of the stocks. These plans are typically geared for senior executives and key employees and can be very flexible in nature. So, form and structure. There are two main types of phantom stocks. Appreciation-only plans do not include the value of the actual underlying shares themselves and may only pay out the value of an increase in the company's stock price over a certain period of time that begins on the date the plan is granted. Full value plans pay both the value of the underlying stock as well as any appreciation. Both types of plans resemble traditional non-qualified plans in many respects, as they can be discriminatory in nature and are also typically subject to a substantial risk of forfeiture that ends when the benefit is actually paid to the employee, at which time the employee recognizes income for the amount paid and the employer can take a deduction. Phantom stock plans frequently contain vesting schedules that are based on either tenure or the accomplishment of certain goals or tasks as covered in the plan charter. This document also dictates whether participants will receive cash equivalents that match the dividends or any type of voting rights. Some plans also convert their phantom units into actual stock shares at the time of the payout in order to avoid paying the employee in cash. Unlike other types of stock plans, phantom stock plans do not have an exercise feature per se. They only grant the participant into the plan according to its terms and then confer either the cash or an equivalent amount into this actual stock when vesting is complete. Advantages and disadvantages. Phantom stock plans can also appeal to employers for several reasons. As an example, employers can use them as reward for employees without having to shift a portion of ownership to their participants. For this reason, these plans are used primarily by closely held corporations, although they are used by some publicly traded firms as well. Also, like any other type of employee stock plan, phantom plans can serve to encourage employee motivation, and tenure can discourage key employees from leaving the company with the use of a golden handcuff clause. Employees can receive a benefit that does not require any initial cash outlay of any kind, and also does not cause them to become overweighted with a company stock in their investment portfolios. The large cash payments that the employer must make to the employees, however, are always taxed as ordinary income to the recipient and may disrupt the firm's cash flow in some cases. As phantom stock plans are deferred compensation plans, they must comply with Section 409A of the Tax Code. The variable liability that comes with the normal fluctuation in the company stock price can be a drawback on the corporate balance sheet in many cases. Companies also must disclose the status of the plan to all participants on an annual basis, and may need to hire an independent appraiser to periodically value the plan. Stock appreciation rights. As the name implies, this type of equity compensation gives participants the right to the appreciation in the price of their company stock, but not the stock itself. SARs resemble non-qualified stock options in many respects, such as how they are taxed, but differ in the sense that holders of the stock options are actually given shares of the stock that they must sell and then use portions of the proceeds to cover the amount that was originally granted. Although SARs are always granted in the form Although SARs are always granted in the form of actual shares of stock, the number of shares given is only equal to the dollar amount of the gain that the participant has realized between the grant and exercise dates. Like several forms of stock compensation, SARs are transferable and are often subject to clawback provisions, conditions under which the company may take back some or all of the income received by employees under the plan, such as if the employee goes to work for a competitor within a certain time period and the company becomes insolvent. SARs are also frequently awarded according to a vesting schedule that is tied to performance goals set by the company. Taxation. SARs essentially mirror non-qualified stock options, or NSOs for short, and how they are taxed. There are no tax consequences of any kind on either the grant date or when they are vested. Participants must recognize ordinary income on the spread at exercise, and most employers will withhold supplemental federal income tax of 22% or 37% for the very wealthy, along with state and local taxes, Social Security, and Medicare. Many employers will also withhold these taxes in the form of shares. For example, an employer may only give a certain number of shares and withhold the remainder of the to cover the total payroll tax. As with NSOs, the amount of income that is recognized upon exercise then becomes the participant's cost basis for the tax computation when the shares are sold. Advantages and disadvantages. The previous examples illustrate why SARs make it easy for employees to exercise their rights and calculate their gains. They do not have a place to sell order at exercise in order to cover the amount of their basis, as with conventional stock option grants. SARs do not pay dividends, however, and holders receive no voting rights. Employers like SARs because the accounting rules for them are not much more favorable than in the past. They received fixed accounting treatment instead of variable and are treated in much the same manner as conventional stock option plans. But SARs require the insurance of fewer company shares and therefore dilute the share price less than the conventional stock plans. And like all other forms of equity compensation, SARs can also serve as a motivation and retain employees. The bottom line: phantom stocks and SARs provide employers with a means of providing equity-linked compensation to employees without the need to materially dilute their stocks. Although these programs have some limitations, industry pundits predict that both types of plans will likely become more widespread in the future. Alright guys, that actually went on longer than I thought it was, so I'll save the other article for the next video. Bye! Hi guys, so the effect of gravity seems to be having a really weird kind of like effect on me here. So don't forget to like, comment, share, and subscribe while I go figure this out. Bye!